just the other week, Melissa Chabot felt we really need to address some of the things that are going on and the commodity price increases. So with that, we actually recorded a little session with Melissa, and we'll like to show that to you now.
Hello, I'm Melissa Chabot. I'm an Associate Principal and the Director of Research and Development at Vermeulens. Welcome to our mid Q1 construction market outlook. Now, we normally don't do these mid-quarter, but because of everything that's going on right now, we decided to give you this timely update. Looking at our trend line, you can see the pandemic-driven flattening out that we've been experiencing for the past year. Well, let me tell you, the bids we were seeing coming in nearly at cost are likely a thing of the past. All that is beginning to change, and we're starting to see price increases in many trades, particularly in the busy markets. So let's start out by looking at oil, lumber, and copper. You'll see oil with a big drop early on in the pandemic and steadily climbing out of its low to where it is now at around $65 a barrel. This is going to impact things like transportation costs on all trades, and it's just one of the many things we need to keep an eye on. Copper is another one that's jumped up significantly, and this month alone it's up nearly 16%, which is pretty crazy. This is going to have the biggest impact on plumbing and electrical trades, and it may be time to start looking more closely at those typical VE ideas that you see thrown out, like using aluminum feeders in lieu of copper on the bigger amperage feeds. Finally, lumber. Wow, lumber. So lumber is up 238% since the beginning of the pandemic, which unfortunately for some projects may put the mass timber structure on the VE list. Related to that though, we have structural steel. So over the past year, the material cost has gone up about $300 a ton, which actually, now that you think about it, might bring the mass timber structures back into play on some of those projects. But we'd want to look at those on a case-by-case, region-by-region basis. Now, looking a little bit more closely at structural steel, during the pandemic, we were holding steady with very few fluctuations in the material, labor, and markup costs that go into the overall rate. Coming out of the pandemic, though, you can see quite a large jump in the overall cost. Part of that's due to the material cost increase of about $300 a ton that we already talked about. We're also seeing a slowdown in productivity as less productive workers make their way back onto the job sites. Also, the subcontractors are busier and thus able to charge a higher markup again. So on a steel job, cost increase, which is looking at around $500 a ton, could represent 2 to 3% in the overall construction costs. So that's an increase of 2 to 3% on a project. Now let's go to our current weather map. We'll just flip through these years here. So this is our current weather map for construction across the country. For reference, the blue is a contracting market, the red is high growth, and then orange, yellow, and green are all the in-betweens. So looking at December of last year, you can see that most of the country is contracting or showing below average growth, which is why our Vermeulens curve showed a flattening. If you're bidding a job in one of these blue states, then you may have seen some bids coming in low or even at cost. Typically during these times, we recommend carrying 10% in ad alternates so you can take advantage of the market if you do happen to get some of those at-cost bids. Now though, if you are currently in design, we're recommending carrying a bidding contingency, and we'll also begin to escalate unit rates with the expectation that vaccination rollout will restart significant growth in Q3 and Q4 of this year. So takeaways from this: material costs are on the rise, so copper, steel, oil, and wood are examples of ones that have all increased over the last few months alone. And then we're recommending carrying a bidding contingency on all projects that are currently in design, and then we'll be escalating unit rates going forward.
So I think Melissa covered a lot there. I think I'm going to tag on a few additional items. One important thing to pay attention to is the US dollar. A lot of the commodities that Melissa spoke to are traded in US dollars, and you can see over the last year we've had a substantial decline in the value of that US dollar, so that is impacting things and will continue to. Also, another thing to look at is labor. Overall, this is the general health and activity of our economy. It really revolves around jobs. And we did have a 1 million job month in March, so that's kind of a preview for our quarter final. But as you can see, we're still 8.3 million jobs short of where we were. And if we look at the next slide, we can see these green lines. This is the labor force. It continues to increase. So we need to add 100,000 jobs a month just to stay neutral. So, at 1 million jobs a month plus the growing market, we're going to need 10, 12 months of 1 million job months just to get back to where we were. Here's the labor numbers, a lot of information on this slide, a lot of numbers, but ones to point out are construction is only down 200,000 jobs from the peak. So very, very minimal. So this is why we're seeing pressure on almost all of our projects. Leisure and hospitality down 3.1 million. So this is really a third of the loss, and that could possibly turn on very quickly. So here's construction just in detail. So you can see the pretty rapid drop off there, but also a rapid return. So 2% down from the peak. That is equivalent to 182,000 jobs. Construction volume continues to grow. I mean, you can see that the pretty rapid increase actually in the last year. Overall, it's up 6% from the pre-pandemic area, but this is really heavily due to residential construction. So looking at this chart, the top portion is our infrastructure spending. The middle portion is our residential spending, which has seen a 17% increase. And then non-residential, which we're going to talk a little bit further about today, and it's generally our markets, is actually still declining, 7% decline. So, there's a lot of question marks if that will continue to decline or take a turn up. So that's what we're watching very closely. And just kind of to wrap things up here, we track numerous metrics and everything is currently showing growth and looking like some inflation coming down the pipe here. So back to our curve, we can see got a few options here where that trend line's headed. Clearly, we're not going to stay in that flat blue line for very much longer. So we're shifting up, and the big question mark that we're trying to help you all understand is when and how much.